It is past midnight. The room is completely dark, and the cold glow of your screen is reflecting right into your eyes. You know you should be sleeping, but instead, you log into your investment account. It is a modern ritual driven by a mix of curiosity and subtle anxiety. But tonight, seeing a balance of $15,000 shifts something entirely. It is not just about the money itself. It is about how the digital ecosystem, the luxury brands, and the ad networks immediately recalibrate their algorithms to target your new reality. The trap is officially set, and almost no one sees it coming. For the moment, the digital readout in your private portal is staring back at you with 5 distinct figures. You allow yourself to analyze that $15,000 total, feeling an immediate, subtle shift in posture. This is more than currency. It is a permission slip. Suddenly, your subconscious is already upgrading your reality. It starts with visualizing a higher floor apartment with a view, a curated wardrobe, and perhaps a reliable European sedan that doesn't demand mechanical attention every morning. The permission to dream has arrived. The hidden truth is that as soon as your profile shifts into financial security, your entire digital ecosystem morphs. Your institution unlocks a premium tier card with metallic details and aggressive credit ceilings. Your trading portal prompts you with sophisticated margin lines and institutional toolsets. Suddenly, your social media feed is flooded with peers executing high-end property updates and checking into business-class lounges. For perspective, central bank data indicates that roughly one-third of working adults cannot manage an unexpected $500 crisis using liquid reserves. Consequently, crossing that $15,000 threshold places you significantly ahead of the general population. This massive gap is precisely why your brain mistakenly registers this milestone as the ultimate finish line. Here's the twist nobody warns you about. For a lot of people who actually hit that number, their savings are lower a year later. Not because they got lazy, because the rules of the game quietly change the moment they win. Here's the twist nobody warns you about. For a lot of people who actually hit that number, their savings are lower a year later. Not because they got lazy, because the rules of the game quietly change the moment they win. Every creator online insists that accumulating your first $15,000 is the ultimate hurdle. That is merely the initial phase. This breakdown focuses entirely on phase 2, the hidden reality of what occurs after hitting that milestone, why that capital naturally erodes if left unchecked, and the exact 3-tier architecture required to protect it. We will dissect the psychological trap that compromises most individuals right after achieving this breakthrough, analyze the compound mechanics that finally begin working in your favor, and map out a clean blueprint, comprising your floor, growth engine, and strategic options that converts a single numeric milestone into a permanent bedrock rather than a peak you constantly slip back from. A quick but necessary disclaimer before we proceed. I am not a financial consultant, and this content does not constitute personalized financial advice. I simply analyze a vast volume of research regarding how capital and systemic incentives truly operate. Approach this as pure economic education, not a tailored roadmap for your specific circumstances. If you are preparing to execute major capital allocations, always consult a certified professional who knows your unique financial data inside and out. Visualize your first $15,000 in the same manner. A structural engineer considers a deep foundational bedrock. Nobody admires bedrock. It is never publicized on social media. It is just unseen, dense material resting far beneath the surface, offering no immediate aesthetic value. That is, until the moment you attempt to erect a significant structure without it, and the entire edifice collapses. Most individuals treat their initial $15,000 like a showcase medal, something to flaunt, admire, or perhaps liquidize for a brief celebratory milestone expenditure. However, capital allocated to serve as a deep structural baseline operates under entirely different mechanics than capital treated as a trophy. A prize merely gathers dust on a mantle. A bedrock serves as the anchor upon which you stack future assets, layer by layer, never to be disturbed again. Keep that structural visual in your mind. We will return to it shortly. You are finally executing every single play correctly. You scaled down your lifestyle, liquidated old gear, and clocked extra hours on a secondary project. Your cash cushion slowly advances from a couple $100s to $2,000, then up to $7,000, and right at that moment, the vehicle's engine blows out. Or your pet swallows a foreign object, triggering a steep, immediate medical bill, or your landlord sends that corporate email announcing a steep rent adjustment. Just like that, you are pulled right back down to square one. If it feels like every single time your net worth inches upward, an unexpected crisis arrives to take a bite, that is not a sign of personal incompetence. That is the baseline modern reality. Working adults are currently allocating a mere 4% to 5% of their take-home pay to liquid reserves on average. Historical economic tracking puts the Personal Savings Index at roughly 4.5% over recent years, which represents a massive 50% drop compared to what was standard back in the 1960s and 70s. The entire socio-economic landscape is meticulously tuned so that most people never drift far from a state of constant, low-level financial anxiety. So when you finally manage to fight your way up to $5, $10, or $15,000, the achievement feels monumental. You review that ledger balance and think, "This is it. I have broken through. I am finally insulated." Then a pair of significant bills arrive in quick succession. You console yourself with the thought, "This is exactly why I built a safety net." And logically, you are correct. However, your brain lacks a strict boundary for how low you are permitted to let that baseline drop. So you repair the engine, support a relative, upgrade your device, and book that overdue getaway. And suddenly, you are sitting right back down at $4,000. You did not fail. You simply treated $15,000 like a final destination. Instead of a hard baseline, you are never permitted to cross downward again. This is precisely the stage where individuals begin convincing themselves they are fundamentally flawed, believing they just lack the ability to hold on to capital. You are not flawed. You simply never received the Phase 2 operational manual, because it is not just your bank ledger that crosses $15,000. A psychological switch flips in your mind, transitioning from "I am drowning" to "I might actually be secure." At that exact parallel moment, the external economic world shifts how it evaluates you. Your banking institution flags your profile as a high-value consumer worth marketing to. Your inbox fills with premium credit card invitations. Financial apps instantly begin pitching larger personal loans, higher spending thresholds, and pre-approved lines of credit. You begin to notice it in subtle, daily ways. Booking engines default their search results to the upper-tier boutique hotels. Your pre-approved credit inquiries suddenly feature five-figure limits. You convince yourself, "I can finally afford to experience life a little," because the raw memory of when your balance sat at $20 rather than $15,000 is still fresh. Meanwhile, the consumer ecosystem around you is actively banking on exactly that psychological vulnerability. Financial entities do not generate significant margins from individuals with zero capital. They extract their yields from individuals who appear stable on paper, but remain highly susceptible to long-term, highly profitable credit agreements. Call it the silent levy that no one ever formally labels a tax. Here is a profound question worth evaluating closely. Why does accumulating your second $15,000 feel fundamentally different from securing the first? When your capital base is minimal, virtually all of your financial advancement is driven by direct deposits rather than organic asset appreciation. If you deploy $1,500 into the market, a solid 10% annual return yields a mere $150. A welcome result, but entirely insufficient to alter your day-to-day reality. There is a powerful psychological shift embedded within the economic data as well. Research from institutional wealth management shows that individuals who maintain a basic cash buffer of just a few $1,000s score roughly 21% higher on metrics of personal financial well-being compared to those with zero savings. Those who advance further to establish a full 3 to 6 month living reserve experience an additional 13% boost in overall life satisfaction. But here is the structural catch. If you constantly draw down from that capital pool every single time it reaches a new peak, the compound mechanics never receive the uninterrupted timeline they require to perform. It is the exact equivalent of planting a young tree, only to yank it completely out of the soil every spring, just to check on the progress of its roots. Let us dissect the single most deceptive trap that materializes immediately after crossing this threshold. You spend months, perhaps years, acting as the disciplined anchor of your financial life. You prepare meals at home. You politely decline group vacations. You actively resist the impulse of midnight digital shopping carts. Then, you glance at that $15,000 total, and a fundamental shift occurs in your personal identity. You tell yourself, I have mastered money. I have proven my discipline. Consequently, you subtly loosen your constraints, opting for premium attire, elevated dining experiences, and gradually drifting away from monitoring price tags. Here is the ultimate catch: that newly acquired identity can quietly convince you to dismantle the exact micro-habits that enabled you to reach this milestone in the first place. Nothing explosive occurs, and that is exactly what makes it so treacherous. A minor monthly subscription here, a slightly more upscale apartment lease there. Your fixed overhead slowly drifts upward until it almost matches your monthly inflows once again, and suddenly your hard-earned financial margin has completely vanished. The moment your baseline balance looks respectable on paper, you quietly transform into someone else's highly profitable business model. Your banking institution rewards your stability with a premium card, a personal loan offer, and elevated spending limits that come explicitly bundled with higher structural risk. Concurrently, your social feeds congratulate your success with targeted luxury vehicle advertisements. Whisper marketing, the ultimate trap. You have earned this. Let us look at exactly what that digital congratulation actually costs your portfolio. The standard monthly payment for a freshly manufactured vehicle hovers around $750 over a 5-year finance agreement, accumulating to a massive total of nearly $45,000, while that exact vehicle sheds roughly 20% of its total equity within the first 12 months of ownership. So how do you actually experience the benefits of your hard work without completely undermining the foundation you just built? The secret is to stop calling it savings and start classifying it as structural layers. Layer 1 is your absolute floor, your non-negotiable, never go below this again capital. This pool is strictly reserved for your rent, basic food, and bare minimum recurring bills to sustain you for a few months. Institutional data confirms that establishing a solid 3 to 6 month living buffer is directly tied to a measurable psychological drop in personal stress. For a vast majority of working professionals, that protective floor lands precisely between $15,000 and $25,000. Layer 2 is growth, the capital whose exclusive, non-negotiable directive is to purchase your future freedom, long-term asset allocations, retirement vehicles, and work-optional years. Layer 3 is options, lifestyle upgrades, travel experiences, career pivot courses, or relocating to a new city. You absolutely should leverage your capital to enjoy these experiences. However, the funding for that enjoyment must originate entirely from the structural layers sitting above your baseline floor, never from the floor itself. Let us look at the quick mechanics. If your bare-bones cost of living hovers around $3,000 a month, a full 6-month buffer requires exactly $18,000. Consequently, your structural floor sits firmly at $18,000 or $20,000. If you currently hold $26,000 in total capital, that extra $6,000 to $8,000 represents the exact zone where your growth engine and strategic options live. You can freely shuffle capital between growth allocations and lifestyle options as your personal priorities shift. However, you do not breach that protective floor unless it is a genuine, existential emergency, and a flash sale on flight tickets absolutely does not qualify. There is an entirely separate, highly dangerous trap waiting for you once you have real capital positioned in the game. You open up your investment interface, and for the very first time in your life, the asset chart looks genuinely impressive. Naturally, your immediate instinct is, how do I accelerate this process? The internet is absolutely thrilled to answer that question for you. Pitching complex options trading, speculative meme tokens, triple-leveraged exchange-traded funds, ETFs, volatile penny stocks, or that hyper-enthusiastic creator on your social feed who claims to have turned $500 into $2 million. But here is the critical catch. Executing just one highly speculative, high-leverage bet can completely erase multiple years of slow, disciplined, boring progress in a matter of hours. In 2024, the S&P 500 delivered a massive return of approximately 25%. Yet, historical research from market tracking firms reveals that the average retail equity investor only captured around 16.5%, lagging almost 9 percentage points behind the benchmark, primarily because they repeatedly jumped in and out of the market at exactly the wrong times. So here is your operational rule. Your floor lives strictly in liquid cash and highly secure, boring instruments. Your growth layer lives primarily in broadly diversified, low-cost index funds. That natural, human urge to try something spicy is permitted, but it must be restricted to a tiny, ring-fenced slice of your options layer. The ultimate goal is to structurally ensure that one poor speculative bet can never drag you back down to the starting line. Two individuals residing in the exact same country, earning nearly identical income streams, let us call them Alex and Jordan, both successfully hit that initial $15,000 milestone in their early 30s. Alex reviews that $15,000 balance and immediately thinks, finally, I am no longer lagging behind my peers. Armed with this new sense of security, Alex upgrades the vehicle, signs a lease on a more upscale apartment situated right at the absolute edge of the monthly budget, and acquires a couple of premium credit cards under the guise of optimizing travel points. Whenever an opportunity for a getaway or a premium gadget arises, Alex comfortably dips into the savings pool to cover it. I will aggressively scale up my investments once my lifestyle expenses settle down, Alex reasons, but the fluid chaos of consumer life never quite settles. By the time they reach their 40s, Alex is earning a highly respectable income, but still lacks the leverage to say no in the workplace. They tolerate the toxic management, the uncompensated overtime, and a persistent, low-grade professional anxiety, simply because their financial cushion is never solid enough to risk walking away. Jordan, on the other hand, hits that initial $15,000 milestone and executes just one fundamentally different play. They decide, this capital is my non-negotiable floor. Jordan keeps their vehicle choices boring. They maintain reasonable, stable housing costs. Every single dollar of newly generated savings is pushed straight into the growth layer, flowing directly into plain, unglamorous index funds and automated retirement accounts. For context, the national average for a retirement account balance hovers around $134,000, but the median balance sits at a starkly lower $35,000. That massive gap reveals that a vast majority of working professionals in their 40s and 50s possess far less liquid wealth than their outward lifestyles would lead you to assume. Jordan actively decides not to become another data point in that low median statistic. By the time they reach their late 40s, Alex and Jordan can boast nearly identical professional titles and identical salary figures on paper, yet they command completely different levels of human freedom. Alex is perpetually trapped into saying yes to poor working conditions, simply because dropping their income to zero for even a few weeks would send their high fixed costs sliding completely off a cliff. Meanwhile, Jordan possesses the ultimate leverage to confidently say no, because their unyielding floor and automated growth layers have been quietly doing their job in the background for over a decade. In Phase 1, money is entirely about tangible transactions. Can I afford this coffee today, or do I have the capital to book this flight? However, once you securely establish your $15,000 baseline, the ultimate lifestyle upgrade shifts completely. Money ceases to be about material objects and starts being entirely about strategic options. It becomes the leverage required to take 3 full months off between professional roles without a hint of panic, to relocate to a city that actually aligns with your lifestyle, or to comfortably walk away from a toxic management environment. Life genuinely gets easier once you break through that initial milestone, but whether it continues to get easier depends far more on the discipline of your next few structural choices than on the specific balance figure you just achieved. Here is your complete financial playbook. First, establish your true structural floor and treat it like a rigid line you never cross without an emergency. Second, aggressively construct a growth layer directly above it. Third, intentionally design an options layer to fund your lifestyle goals. Fourth, maintain deep skepticism toward any institution selling to you once your capital grows. Finally, when you slip up, treat it as a temporary detour, not proof you are financially doomed. The number in your bank account matters, but your operational rules matter infinitely more. Protect your initial $15,000 like a solid concrete foundation underneath everything you build, and refuse to let temporary impulses turn your foundation into a finish line.